When you hear the word cryptocurrency, your mind probably jumps to volatility, to speculation, to charts that look like mountain ranges and narratives that shift overnight. But some technologies are built for the exact opposite purpose. Imagine a digital asset that doesn't exist to increase in value, that isn't trying to compete with the dollar, but is simply designed to maintain stability while radically improving how dollars move in a digital world. In a space defined by uncertainty, this asset represents predictability. That asset is USDC, and that difference is what makes it so important.
Hey, Norman here, and welcome to The Breakdown, where we take complicated ideas and make them easy to understand. We take messy concepts, big questions, and confusing systems, and we break them down step by step until the full picture is clear. So if you have questions, please post them in the comments. Now, let's get back to video.
USDC is a stablecoin, and that name means exactly what it sounds like. One token is designed to equal one United States dollar at all times, not approximately, not based on market sentiment, but a strict one-to-one peg. This anchor isn't based on a complex algorithm or wishful thinking. It's backed by real-world reserves held in cash and short-term U.S. Treasury securities. Think of it like a digital claim check. For every one USDC token in circulation, there is one US dollar held in a reserve managed by institutions like BlackRock and audited by firms like Deloitte. This creates a bridge between the familiar world of traditional finance and the new world of blockchain infrastructure. It's not trying to reinvent money, it's giving the dollar digital wings. The goal isn't to replace the dollar, but to unlock it, to make it programmable, portable, and globally accessible in a way it's never been before. Consider how a traditional dollar moves. It travels through banking networks that operate on business hours, rely on a chain of intermediaries, and often take days to settle a payment across borders. If you've ever sent an international wire, you know the waiting game. USDC transforms that entire process. It allows dollar denominated value to move 24 hours a day, 7 days a week, across blockchain networks that settle transactions in minutes, not days. And it does this without needing a series of institutional handshakes along the way. Settlement becomes a software function, not a banking procedure. So, how does it maintain that perfect one to one balance? The mechanism is elegantly simple. When a financial institution deposits US dollars into the system, an equivalent amount of USDC is minted, created out of thin air, but fully backed. When a holder wants their dollars back, they redeem their USDC, and those tokens are burned, permanently destroyed. The supply expands and contracts in direct response to real deposits and withdrawals. This isn't about speculative incentives, it's about pure utility. And this controlled issuance is fundamental to its stability. Transparency is also central to the design. The reserve holdings are publicly attested to, confirming that the supply is always backed. It doesn't eliminate trust in the way some cryptocurrencies try to, but it provides clear visibility into the structure that supports it. That transparency is precisely why major institutions, payment platforms, and financial apps are willing to build on it. Because of this stability, USDC is used for incredibly practical purposes that have nothing to do with speculation. For global payments, a business in the US can pay a contractor in the Philippines in minutes without navigating the costly and slow correspondent banking system. In the often volatile crypto markets, it serves as a safe harbor, a neutral unit of account, allowing traders to move out of a fluctuating asset and into dollar stability without ever leaving the blockchain environment. And in the world of decentralized finance, it's the lifeblood. It acts as collateral for loans, provides liquidity for exchanges, and functions as digital cash for payroll and treasury management systems that are run entirely by code. Yet, this stability is not without its trade offs. Its reliance on regulated financial institutions and real world reserves means it operates within existing legal frameworks. And this has a very real consequence. USDC addresses can be frozen. If a court order is issued, or if an address is linked to illicit activity or sanctioned individuals, Circle, the issuer, has the ability and the legal obligation to block the funds. This makes USDC fundamentally different from decentralized currencies like Bitcoin that prioritize censorship resistance above all else. But this isn't a flaw in its design, it's a deliberate choice. A prioritization of stability, regulatory clarity, and compatibility with the existing financial system. This choice highlights a deep philosophical divide within digital finance. Bitcoin was designed to remove trust from money. It has a fixed supply enforced by a global network of computers, prioritizing scarcity and the inability for any single party to control it. USDC, by contrast, accepts the existence of trusted institutions and regulatory frameworks. Its goal isn't to build a new system from scratch, but to enhance the speed, transparency, and programmability of the dollar within the current one. One seeks to minimize reliance on institutions. The other seeks to optimize how institutional money moves. This is why Bitcoin is often called digital gold, a store of value outside the system. USDC is something else entirely, digital cash, built for movement within the system. This difference explains why USDC has gained so much traction among corporations and developers. Programmable dollars can be embedded directly into software. Think of automated royalty payments that execute the second a song is streamed, or international invoices that are paid automatically the moment a shipment is verified. Treasury departments can move millions between global accounts instantly, any time of day. Global freelancers can receive payment in digital dollars without waiting a week for a wire to clear. At the same time, USDC inherits both the strengths and weaknesses of the dollar itself. Its value is tied to the purchasing power of the US dollar. It doesn't insulate you from inflation or monetary policy. It simply provides a far more efficient delivery mechanism for dollar denominated value. Ultimately, USDC should be understood not as an investment, but as infrastructure. It's a tool designed to reduce friction. In a world where information moves instantly, but money often does not, USDC narrows that gap, aligning the speed of currency with the speed of the internet. It doesn't promise ideological transformation. It promises stability and efficiency. And in a financial landscape increasingly defined by digital interaction, that quiet, predictable function may prove to be far more revolutionary than volatility ever was. In short, USDC is digital cash designed for movement rather than appreciation, for efficiency rather than scarcity, and for integration rather than disruption. It allows traditional dollar value to function within modern digital networks, closing the gap between financial infrastructure and internet speed. And that's the breakdown. If this helped, hit like and subscribe so you don't miss the next one, and drop a comment with what we should break down next. Stay curious and keep learning.